All right, good morning, everybody. Today we get CPI, which gives us an opportunity for a liquidity gap play. I love this trade. We get multiple opportunities every month. CPI, PPI, non-farm payrolls, all of those 830 prints that offer us this opportunity. And then intraday during the week, it's always possible to see one of these happen within the trading day, but being able to anticipate it, knowing the time frame for it really helps out a lot. As with most strategies, I found that if I show examples of what we're looking for and examples of what we do not want to see, it really helps people out. So this is what we're looking for. This was one of those events, an 830 print. I can't remember if it was PPI or CPI, but it doesn't matter which one. Notice it's a single direction push. There's almost no wick across the top. It ended really close to the end of the candle. Then we had this bottoming formation. And if it had been any other way, maybe a topping pattern, then it worked its way back to the 830 open. So that's the gap that needs to be closed. I get it. You don't see a gap, you see a candle. This is a liquidity gap, creates a vacuum. Price moved so far, so fast, and there was unfinished business. And there's a wash here. It's a void that needs filled. Price goes back and fills that void. It got there at about 11 o'clock. Those who know me has been around for a while know when I say watch the clock, that's exactly what I mean. Watch the clock. We get economic events on a half hour or a new hour. Markets close and open around the world on a half hour or a new hour. And we change direction within the markets on a half hour or a new hour. So watching the clock can provide all kinds of insight that, if you're day trading, will open up a whole new world of possibilities and ideas. Watch the clock. Here's another example of a gap close. This one to the upside, 830 print, single direction push, almost no wick across the bottom, closed near the top. Not much of a base was built here or even a topping pattern. It just immediately started working to close the gap. It got the gap closed around 10:30, and then we got that nice reversal at the lows there about 11 o'clock. Another example, same thing, single direction push, not much wick along the bottom. This one's a little bit different. It actually pulled back from the highs just a little bit. When this happens, we want to measure this entire candle and look at where the midpoint is. We don't want price to close near that midpoint. We want it in the upper portion as much as possible, or if it went to the downside, we want it in the lower portion as much as possible. The closer it gets to the midpoint, the more invalid we would consider this to be. Also on that midpoint, it was strong. That's where price had a hard time getting through. Actually started to build itself out a little bit of structure there before it finally made it through. Also on that wick, it became structure all on its own. The next bar had a hard time getting through it. Then we finally did break through it. We would have been able to measure this entire bar and plot it to the upside 50% and then 100%, giving us upside targets. Once we built that top, kind of a basing pattern, then we begin the rollover, still trying to get back to the gap close. Got there around 11, a little early, but still we got there around 11 o'clock. This is what we don't want to see. It's a really good example of measuring the candle, plotting out those levels higher. You'll notice that when we plotted out those levels at some point later in the day, we did eventually test those levels, but we didn't get past that. This is doing analysis on a single candle, which If you've been around for a while, you've seen me do this before. You pick a very important candle and you perform analysis on it. Lay out quant levels, fib lines, halfback markers, everything. That halfback was really close to a cog line, 50.32, 50.33. It became an area, a structure of resistance. This gap close happened really fast. We got back down where we started. This isn't one that we would want to trade. If we measure the big breakaway candle, first, there's a lot of wick on the downside. Second, we close near the halfback. We don't want to close near the halfback. It invalidates the whole thing. Now, look, I'm not saying you can't trade if it doesn't give you this perfect setup, this liquidity gap setup. I'm just saying it won't be a liquidity gap play unless it has all the characteristics that are supposed to be there. So you can still trade it. You just won't be trading a gap close play. You'll be trading something else. So this is what we don't want to see. Big wicks closing near the halfback and a wick going in the other direction. Here's another example of what we do not want to see. Big wicks in each direction. Price closing almost where it started. This is worthless. It's invalid. We wouldn't want this. Now, even though we might not trade this as a gap close, it's still a really important candle. So we can still lay out its open. We can mark its high and its low, and we can build measured moves off of that. And if we were to measure this, we'd notice that's where we topped out. That was a measured move across the top here. So the CPI print today, just like the PPI print yesterday, is a data point that we can use. We can, lay out quant levels, mark the halfback, check its volume status, look at the flows. Depending on the tools that you have, you can actually go in on the dome and see them defend those levels later on if price does come back and check them. It's another example of what we do not want. Big wicks in each direction. This is what we do not want to see, right? So we can use that candle, do analysis with it. We just don't want to try to trade a gap close play. Same thing, another example of what we don't want. Here's an intraday example, a 10 a.m. print. We had a big drive to the upside, almost no wick on the bottom, closed near the highs. If we were to measure that out, it'd give us measured moves to the upside. Then we had another one here. Big drop to the downside, almost no wick across the top, closed near the lows. Price worked immediately to get that gap closed. Still wasn't able to get through it. Then dropped down and closed this gap, leaving another one right here, which we then immediately turned right back around and ran back up again to get it closed. They can happen anywhere, even in the intraday. So this is on the table for the day. This is what we have. CPI. Markets are kind of flat this morning. They've been flat. Yesterday, it took an iron condor into the afternoon. Once we made it through PPI and POW, and the market was still range bound, that was all I needed to see right there. So it did that. Japan's basically flat. All the other markets are flat, and we have the UK up slightly at 0.25% with the Russell right behind it. Bitcoin is up a little bit this morning too. We'll take a look at that. Bitcoin's a liquidity tail, and it is one of the most riskiest assets out there. So when we're trying to gauge what they say on Bloomberg, the animal spirits, trying to gauge the the hunger of the market, how aggressive are they for taking risk? Seeing Bitcoin up tells us that we want to also circle back and look at IPO names, because IPO names are another high risk venture. And we want to see if this behavior is spreading out into other risky assets. It's just more of a sentiment tell than anything else, right? But if Bitcoin is looking good, then there's all the Bitcoin plays: Riot, Mara, Hut, Hive, Coin, MSTR. We get to play all of those if we are going to get that turnaround. After we're done with PPI, we still have, after we're done with CPI, we still have other data points. So it's not like this is the end of the road, but it is the biggest thing on the table. And then, of course, at the end of the week, we have OPEX, which, if you were reading Spot Gamma this morning that I posted, that's one of the things that they pointed out. And they talked about that 5,300 level again in the SPX. They're still calling that as a sticky magnet. So if we get there, we're probably going to pin around that thing into OPEX. And the key word in that was if we get there. So Monday in their write-up, they called for, like a long call play into 5,300. But they did stipulate if we were to break down, then, it's probably going to be a straight shot lower into, I can't remember their levels now, but I think it was 5,100. We can see on FX Street, there are a lot of events today with this deep red background. This is a high impact, high volatility warning. And then we have data out of Japan tonight. So even for any sort of swing trade, we're still going to have to be mindful of data that is likely going to come out of Japan and shake the market up a little bit. It does look like crude is about to break down too. That'd be a part of that rotation. All right, let's start with these pivot point channels. We can see how wide the channel is today. The pivot point is in purple, and the channel are the yellow lines above and below it. We had 2 days in a row where they were really close together, although it did have an overlapping higher value, and they were very narrow. And on narrow channel days, we have the capacity to rally. That went really well, by the way. Went right to the ADR line. Great call out. The distance from the pivot point on the weekly is a little stretched, but not too far. This is a little overbought from that point of view. This is a weekly pivot, and that's what we're talking about, this 52.20 weekly pivot down here. You can see that compared to where we've been recently, that's not too bad. But if we were to put that on a daily, that's nothing compared to, being 1.5 or even 2% away from that weekly pivot point. This is that weekly line that we're talking about, and you can see we've been farther away than that. This is the setup they like to use on finance juice when we have events on the horizon. They've got the Dixie, the DXY on the left. Then they have the ES in the middle, and they have the 2-year on the right. And you'll see after important data comes out, this is usually the 3 grid that they post. You want to see the dollar and the 2-year move opposite of whatever the S&P is doing. And very often, this 2-year starts moving in the right direction before the data comes out. Now, of course, that's always tricky, right? Because they're trading anticipating what the data is going to be. And they're probably right most of the time. So right now, the 2-year dropping down like this really fast kind of implies that the data is going to come out in a way that makes the S&P go up. Okay, how much do you want to risk on that? So it's something to keep your eye on. I'm pointing it out because it's something that I've noticed after a while. And if you want to build your own systems or develop your own strategies, recognizing things like this are how new strategies are developed. So I'm pointing it out there. Just remember they can be wrong too, right? Somebody's front running this data because they think they have it all figured out. We'll see. I mentioned yesterday that the volume was really light and that we couldn't see any hedging because the hedging marker that we use would only show up if they were trading yesterday's options to hedge. And I suggested that they probably were not using yesterday's options to hedge because they had 2 days of hedging that they needed to do. So why not use today's options to hedge? We can see this morning that hedging activity. So they are trading in the front end. They are hedging. This isn't my opinion. I'm not guessing or assuming that they're hedging. We know for a fact that they're hedging. And I feel I was right yesterday when I mentioned that they were also hedged yesterday. They were just using today's contracts to do it. It's a tell. Now we know why they're hedging today, but if you came in on just any normal day of the week, we didn't have econ on deck, and you've seen the volume really light with hedging activity in the corner, you would want to just call timeout right there and go find out why are they hedging? What has them concerned enough that they're actually spending money to protect their position? Because it is cost. Like sitting in front of the fireplace, just throwing money into it. They're spending money. So they're not going to do that unless they are worried about something. We're still above that voodoo line forest, 52.46. That's really close to 52.50. We are above last week's high. We could see Friday's high here. We got that breakout yesterday afternoon. We've still got it. We have a very narrow range, what they call an IB. So an open range can be anywhere, and it can be whatever size you want. You're the boss. When it comes to initial balance, it's always 1 hour, and it's in the Globex between the open at 6 p.m. and 7 p.m. Now, I've heard some newer traders and some younger analysts who say that the IB is at 9:30 and it's from 9:30 to 10:30. I'm not going to say they're wrong, just they've taken something and they've modernized it and brought it into the RTH, the regular trading hours. I don't necessarily disagree with them. I just don't like it. So I'm going to keep the IB between 6 and 7 in the Globex, and any open range that I use in the regular trading hours is just that. It's an open range. There's more to the backstory of initial balance than just what time it opens and how long it is. It has a lot to do with what nations are open at that period of time around the world. And the lack of open markets is a big part of the whole thing. I think Dalton got into that quite a bit in his books. Jim Dalton, he's like the big footprint chart guy. TPO charts, footprint charts, that kind of thing. You learn a lot more about that logic in that kind of material. So we're looking for this big data print. If we set aside what we were just seeing in the 2-year, which is implying we're gonna go up, set that aside for a minute. We're nearly equally balanced between the ADR red line up here and the ADR red line down here. And that makes sense because we're basically flat this morning. We haven't done anything. We're up 2 points. Woohoo. So we don't really have a tell for, if we were a lot closer to the upside, we'd just say we're probably going to go to the upside and get that hit. So we don't have anything from that. We have a 0.60 market maker move on top of a 1.1 average daily range. And what we can do with this is we can add them together. So the average daily range is just a little over 1% a day. That's, if we just round it, it's 60 points. Then we take this 30 points here and we add that together. That's 90 points up or down that we could move from the close last night. Well, the yellow line up here, that is the ADR. So that's our 1%. That's our 60-point move. And we can add another 30 points to the top of that. $53.50, I guess 53.55 is closer. I'm not really going to nerd out and, get out the calculator and get this dialed in perfectly because it doesn't matter. There's a voodoo line here at 53.50. If we get near that, which is also an options level, we're going to go to it. Very likely we'll stick there. And if we get above 53.50, we'll likely stall out a little beyond that. And then we'll use 53.50 as support. Going the other direction, we have the ADR low here. $30 points gets us down to 51.80. There's a voodoo line at 51.82, so that's close enough. It works for me. To even get down there, we would have to break through that 5,200 round number. That's going to be hard to do. There's a lot of options there. It's a zero gamma level. We'd have to get through the volatility trigger, the 10-day moving average. So many levels we would have to hit and work through to get down to that level. It's possible to do that. I don't want to discourage it and make it sound like I don't think we can do it, because, oh yeah, we can do it. Keep in mind, when it comes to a data print like this, none of these pivot points matter until after that initial push comes through. All those big candles that I was showing you earlier, where we were talking about the liquidity gap play, that big candle will run through anything in its path. Doesn't matter what it is. Only after that first candle closes, if there's not an immediate follow-through candle that continues to move even farther in the same direction, then we start laying out our quant levels and we bring back into focus all of these pivot points. 10-day, 30-minute volume profile, we really don't have anything here. Through the day today and through the rest of the week, we're going to lose the lower end of this profile. And as long as we don't break 5150 and 5140, 5132, as long as we don't break this low, then what we're going to see is a more narrow profile by next Monday. Now, if we break higher, then of course the profile is going to expand to the upside. Otherwise, we're going to have a significantly narrow profile. 5278 down to 5130. For a 10-day profile, that's pretty good. We've seen it more narrow than that, but we don't want to get into that. We're not going to see the volume build out at that 5245 area. And there's no other place where we're expecting to see the point of control move to until we start to develop a new volume shelf somewhere. We really didn't build one across this high here as much as we were looking for it. There's a couple of things in that, right, that kind of imply they weren't really interested in trading at this level. That could send us back to the point of control, or it could just imply that, we're just going to keep moving on up from here. So there's a question about, would this be a gap fill? Not on this time frame. If you were looking for the image, right, that think of it like a Head and Shoulders or a flag or a cup and handle. If it's just a collection of candles all trashed together, you have to squint and close one eye and tilt your head sideways to see it like an ink blot. Does it really count for a pattern? Most analysts will say, yeah, it still counts. No matter how ugly the pattern, it still counts. But I've noticed that they trade really poorly if the pattern is hard to see or hard to identify, because most people aren't going to see it. With a liquidity gap, one of the easiest things you can do is just pay attention to how it looks. If it looks poor, then it's probably not going to behave well. If, on the other hand, you want to struggle with liquidity and you don't care about how it looks, then you want to see how fast did it happen. Now, this is what they call one-time framing, mostly, at least on the 5-minute. There was some pullback here. Usually one-time framing would be something like these 3 candles repeated all the way up, and there wouldn't be any pause like this along the way. It would just be like those 3 and those 3 nonstop, up, 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 up. But this didn't do that either. It ran up, paused decently, a little bit of consolidation, another 3 bars, paused. That doesn't feel like a runaway market. It doesn't feel like one-time framing, doesn't feel like trapped traders or unfinished business or that anybody got left behind. There's no swing low pattern. There's none of the qualifications and criteria exist there, other than the fact that it moved relatively fast compared to everything else. And on this time frame, it just isn't there. But if we go to a different time frame, that does fit. So for me, that would not be a liquidity gap. It would help, though, if you do have that sort of situation, if you can tie it into a specific event and starting point. If we take that one, did the starting point happen at 1 o'clock when we flipped? Or did it happen at the first really big candle push, or did it happen after we started into the new high a day? Being able to lay out those key points would help a lot. But I like the visual more than anything else. The visual is the easiest thing to spot. So if it's a 3-bar play or a swing low or a swing high, that's excellent. Or if it's just one big, massive candle, because that gives us a candle that we can analyze. Then even if that's not a liquidity gap, that really big candles is still a tool that we can use. We can lay it out, put our quant levels into play, everything else. I use the phrase unfinished business a lot, but this is what I'm looking for with a really good unfinished business. That little 3-bar swing high right there. And of course, it can be a swing low too. And I zoomed in on this level just to show that 3-bar a little bit better. They can be all over the place, right? They can happen anywhere. This is the best looking setup. And once price leaves that zone, mark it out. The distal line, the proximal line, this is the magnet that I'm expecting price to go back to. Just like that. That's that same swing bar right there. That's the zone or the level. That's what we're expecting price to come back to. So it's not just a liquidity gap by itself, which is great. I do like a liquidity gap, but it's also, what are we going to do with it? Is it a tradable opportunity? Does it become a magnet for price to come back to? Is it, a gap fill play that we're going to expect to see get filled that same day? And if it doesn't fill the same day, then what? Do we map it out and throw it down the road day after day until it does get filled like a regular gap? Lots of opportunity to build that out, put a strategy together on it. We have a VPOC now from yesterday. This point of control hasn't been hit. So if we do break below 52.50, which is an options level, and it makes sense that we would overshoot it, then there is liquidity on the other side, which is what we say all the time. Anyways, liquidity resides on the other side of the pivot. If the pivot is 52.50, we get into the other side of that 52.47, we're very likely going to find liquidity there. On this 5x5, today's very narrow range really stands out. It's one of the reasons that I just love this 5x5 chart. Now, I know this looks like a volume profile, but it's not. It's TPO. This is the volume profile. The difference between these is one is volume by time, the other one is volume by price. TPO and point of control, and volume profile and point of control. There was an announcement last night on TradingView that they now have footprint charts, which is really awesome. This just happened. Well, it said 20 hours ago, so maybe a lot of you have already seen it. I didn't see it until this morning, but that's awesome. My Jigsaw platform has footprint charts, and Tradeovate has footprint charts, but TradingView did not have footprint charts. So now we have those. Unfortunately, though, when I was reading how they were calculating their buy side and sell side volume, they're using more of the on balance volume approach. If you've studied indicators at all, on balance volume looks at how we closed on the day. If price closed higher than the previous day's close, it takes all that volume and assumes that it's buy volume. That's a pretty big assumption. If price closed lower than the previous day's close, then it takes all the volume and assumes that that's sell volume. Again, that's a really big assumption. So if you look at the footprint chart article that they wrote on TradingView explaining how they're doing these footprint charts, they're doing it exactly the same way on whatever time frame you happen to use. 1 minute, 1 hour, 1 day. It's just taking all the volume and assigning it to buy volume or sell volume based on how we closed. That's not how Jigsaw does it. Um, I'm pretty sure that's not how TradingView does it, or Tradevate does it either. That's a pretty generic way of doing it. I'm hoping they improve that, but something is better than nothing. So, it's always the little details, right? You gotta read the fine print, see how they're putting tools together. Otherwise, you give it trust that it hasn't earned. Make a heck of a mess. So we have the weekly expected move here, 52.98, which is a front run for 5,300. We're supposed to close inside this box 8 out of 10 times for the S&P, 7 out of 10 times for everything else. And if you count back over the last 10 weeks and look at where we were on Friday at the close, you'll see that we're not holding up our end of the bargain here. We're closing outside the box more than that. So volatility is being mispriced and the markets are moving farther than volatility says they should. That's a warning about doing swing trades on iron condors, butterflies, that sort of trade. I was trading an iron condor yesterday, intraday trade, in and out same day. Nothing wrong with that. And still, thankfully, talking about that big push, I put on an afternoon iron condor yesterday, collecting about $150 in credit. And when it hit $100 profit, I went ahead and closed it down. It took about an hour. And it wasn't very long after that when we had this really big rip. If I'd have got greedy trying to get more out of that, it would have ran me over. It was a $5 wide iron condor, and I only had $1.50 in credit. So I was risking $3.50 for that $1.50. I used Friday's high, which isn't on the screen here, but Monday's high and Friday's high were basically the same. That was the upside level. I'm pretty sure. Of course, it's the SPX is where I did my position, but it was still Friday's high, Monday's high. And it sure looked like a slam dunk, no problem, right? Sideways day. We're waiting on PPI. Should be able to hold that into the close, no problem, nice and easy. Yet it got to $100 and I closed it out. If I hadn't, the thing would have ran me right the heck over. I'm not pointing it out to say, look how smart I was to close it early. I'm pointing it out that even though this was a slam dunk, having an exit plan, a price point to get to just shut it down is a really good idea, especially when it comes to the indexes. These things are notorious for just making those afternoon moves. We've seen it time and time again in the indexes where we'll have a sleepy, slow, boring afternoon that suddenly just lights up and it rips. We've been going sideways enough that now we're ready to go. We're just starting to develop a little bit of a megaphone pattern here. We zoom in some. So this megaphone pattern, once you've got a high and a low set, you start to look for price to wobble a little bit. It breaks higher, breaks lower, and we're looking for that expansion just a little bit more and a little bit more, with price breaking each new low and each new high just a little bit higher, a little bit lower, until finally we really run. Now, I showed going in both directions, but really we can hold a high and we can just keep breaking lower and lower and lower to where it would be like a flat top and an angled bottom, or the same thing where we can have a flat bottom and an angled top. A megaphone doesn't have to be perfect where both sides are widening, but at some point it's going to break. That outside bar yesterday did close bullish. And if we didn't have economic data points today to be concerned with, then we could just capture that, put a midpoint on it, and say we need to stay above that level. This gray line here, that's last week's close, 52.41.5. Well, the halfback is 52.45.5. I mean, come on, it's close enough. We need to hold above Friday's close. I think if we get below that again, we can see how aggressively they bid that back up. They were good buyers here, both sides, both times. But will they continue to be? It seemed like it took them a bit longer to buy it back up as opposed to the 10th and the 13th, Friday and Monday. We got a little bit deeper down yesterday. So if we do cut below Friday's low, really kind of analyze that tape, not just looking at it for the market participants, how fast the tape is moving, but look a little bit beyond that. Look at the dome and see where those orders are at. How strongly are they trying to bring this back up and defend this low? We're not quite back to our 2% mark, but we're at 1.9% above the 10-week moving average. That's a good point. It's a good place to be. We want to just continue that drive, nice and easy, nothing too fast. Let's get back into a +2 here, which is where we've been for most of the year, really since November last year on that QRA. And for the 10-day, we're still holding around 1%. So we're not overbought. We're not overextended. We haven't traveled too far too fast, and it doesn't owe us any sort of pullback. All right, Bitcoin is up the most. Then we got nat gas, which is trash. China ADRs through the K-Web, some uranium, and that's it. Anything less than that doesn't meet our benchmark for a 0.5%. Flip things in the other direction at what's down. Nothing is down enough, which is a 0.5%. Nothing meets that qualifications. So BITO is the Bitcoin proxy that I tend to use to see what's happening in the pre-market. We can see this persistent move to the downside, and it's not done. Even with this move up right now, we're still just looking for a lower high, right? This has been a textbook example of lower highs and lower lows, and nothing here says that it's done yet. So we're up a little bit today. Yay. And that means we could play some of those Bitcoin proxies, but we won't be looking for it to stick yet. This is BT. That's a nice flat top with higher lows on the bottom. But when we zoom out, we can see there's still a lot of work to do. We got a trend line breakover. So that is aggressive, but it still has to get through 233. And I mean, this, you see, this is just beat down trash. That's a really awesome wedge. Lots of compression building up here, but Again, we're not looking for, something long term. Some names that are more recognizable. Coin, it's already showing struggle just to get outside of yesterday's high. So Bitcoin may be up, but as one of its proxies, this isn't looking very impressive yet. Mara is another one that's recognizable. Most people who play this space is going to know this name. It's been looking pretty good, but again, it got the inside day breakout and it already failed and gave it back. We also have Monday's high, and it wasn't even able to get outside of Monday's high. So that's just more indications of weakness. Riot made it through Monday's high, made it through yesterday's high, and already gave it back. It's more weakness. So sure, we got Bitcoin up this morning, but it's not looking good so far. Keep your eye on it though. It's a little bit of a slow start, and there's still the PPI, CPI, POW stuff to get through, right? We're almost done with it. Once we get through 8:30, still we got to get through it. The China ADRs would be the next way to go if we can't do the Bitcoin plays. But, look at BABA, that big dump down and a little bit of a move to the upside this morning. Not very encouraging, to say the least. And now that we've got this really big bar, we can mark out that halfback. And as long as it's under the halfback, then there's no bullish play here. Baidu, really nice gap up this morning in the pre-market, but it still didn't get through Monday's high or yesterday's high. Got a gap to close at 113 and a half ish. So if we do get that breakout, but I mean, look at all those sellers across this high here. They're really defending that high and knocking them back down around 112. Same thing, PDD, a little bit of a gap up this morning. It's already washing out. So none of those China ADRs are looking any good this morning, not for a day trade, right? This is no analysis on how the China names are doing, for a continued swing, because that K-Web has done really good, right? Look what it's been doing. I mean, no argument there. But for a day trade, none of these names are looking really good this morning from the China ADRs or from the Bitcoin proxies. So we need this data print. It's going to come out in 10 minutes. That should set the tone on the day. You already know what a gap close looks like. So if it's really bullish and closes near the highs, then, keep that in mind. I, I, I always forget to say this. So let me say this. If you get the print today, up or down, it doesn't matter which direction it goes, and we have the gap close set up, just keep in mind it does not have to close. There's no guarantee that just because it gives you the right print and it looks like it's a gap close setup, there's no guarantee that it's going to close. And I don't say that often enough, but I've seen these give a perfect gap close setup and then it just keeps going in that same direction. So this big move down, just for an example, and then we got the base. I've seen it just continue to go to the downside and never come back up to get that gap closed. Okay, same thing on the positive side. So keep that in mind, right? That it does not owe us a gap close. It's just the most likely scenario. And that's why I showed those three charts. Because if it is a big, beautiful gap close setup, the dollar and the 10-year should give us a move in the other direction, which means when the flip comes, when we try to close that gap, we should again see the 10-year, the 2-year, the dollar turn and move one direction, and the ES turn and move the other direction. Right? Everybody be careful, be safe, have a good day. I'll see y'all tomorrow.